Good morning, good evening, and good afternoon, everybody. Hope everybody's having a great week. It is Thursday. You know that means it is time for high probability short term profits. First up, we're going to be talking about a quick market review. We're going to look at the wholesale prices. Then we're also going to go through some of the sniper portfolio that we have going on right now. Up to 16 straight wins, 92% win rate. That's not too shabby. Not too shabby at all. We're going to talk about a couple of recent trades, Peloton and Electronic Arts. Then we're going to go through a current trade that we have today. And if what Mike has said indicates anything, it is a wild time right now. There are so many sniping candidates out there. Then we're going to go through some of your stocks, which I already see y'all have a ton in the chat and y'all are ready to go. So let's get things going. Mike, are you out there anywhere?
I'm out here in the jungle in Costa Rica.
Let's see that view again.
Oh, you mean that view?
Yeah, that one. Yeah, that one. As I'm sitting here in rainy South Carolina, it's 34 degrees and rainy, just miserable.
I'm sorry. Well, I told you could come visit anytime, man. Come on down. Anytime. What's our win rate again, man? What's our win streak?
Measly 92% win rate, 16 straight wins. Measly.
What? Yeah.
It's crazy.
Our record is 18. Last year we had 18 straight wins. And, you know, the name of the show is High Probability Short-Term Profits. And the high probability, as you mentioned, Ryan, 92%. And it's difficult. I'd say good traders are usually around 60%, 70% wins.
Mm-hmm.
That's really good if you manage your risk. But with us, we pretty much don't lose very often, 1 out of 10 roughly. And right now we're at a 92% win rate. And yeah, we're doing really well. And we'll lose. There's losers coming. My job here on Thursdays is to distinguish the best candidates, the ones that have the highest probability. And we come in and snipe. Let's put this up, the graphic up, Ryan, because I'm talking about it now. I don't need to come back and say it again with a graphic, but you know, we're making about 11.26% every 5 days. You know, think of the movie Moneyball. Get on base. 1 out of 10 batters we are struck out. And you know, if you imagine being able to generate 10% every 7 days, which is our average run rate. Think about that. You could take $377 or $50 or $5,000 or 10, whatever your position size is, and you can just keep cycling that money week by week by week. And 11 or 10 even % profit every 7 days adds up over a month, and you can do that math. So that's what we do here, and we've been doing this. These results started at the beginning of 24, and we're just keeping a report card since we started. So this is not like the last month or just the win streak. This is from when we started. Indeed, we've lost 5 times out of 62 trades. That's phenomenal. All right, so it's a very specialized system. I put this together to in a very systematic fashion, a system that's based on very distinct rules, and we have a guidebook, and we can put that up too, Ryan. I'm sorry, I'm off script again. But you probably
are me way off, man. Way off.
But yeah, there's a guidebook. You can grab it down below in the link right below my face here. And it takes you through the 5 steps of finding opportunities, creating a risk graph, identifying lines in the sand, managing the trades. We use things called credit spreads, which are not beginning strategies. I wouldn't call them advanced, but let's call them intermediate strategies that give us the high probability. Not even give, but add to the probability that the news provides. So credit spreads is what we do here, and it takes a little bit of learning. So there's a free guidebook. Grab it. Be with us on Thursdays at 9:15 Eastern. We're here every week, right? Right, Ryan?
Yes, sir.
Most of the time. All right, market review. You know, last week I was talking about tariffs. We call them the Trump tariffs. And we had a CPI come out, a producer price report come out this morning. Wholesale prices rose 0.4% in January. So here's the fear. The Fed is concerned about cutting rates because tariffs can exacerbate inflation. Our inflation rate isn't quite where we want it. And what we're seeing now is the prices for producers has risen a little bit. All right, so that looks like that the economy is doing so well that prices are rising, even with the few rate cuts we got last year. So it's beginning to get a bit like a pressure, a pressure keg. The markets are already. I mentioned this last week. This is a chart of the SPYs, the ETF that tracks the S&P 500, and we have had let's call it volatility. We've had so much volatility in this market since the Trump presidency. This is when Trump won the election, and you can see just wild gyrations. And we've been even and lots of gaps, which is a few gaps here and there on the SPYs, the 500 biggest companies in the United States stock market. You get them sometimes, but man, there's a boatload of them here, and you can just be on the lookout for them, be ready for them, because we could go anywhere, anytime. So now I'm looking at the picture with the producer prices raising a little bit from the last report, signaling inflation might be raising its ugly head again. The Fed is reluctant to cut rates because they're afraid of Trump, the Trump tariff impacts on inflation. So there's a lot of pressure, and you can expect a lot of movement. So the bottom line is expect volatility. It's very difficult to predict where we're going to go next. So what I use are lines in the sand to tell me when it's more likely that the stock market will rise or more likely that the stock market will drop, especially in this gappy market. That is a tricky proposition. So for me, I make it simple. If I see the SPYs close above 610, round number, at resistance, line in the sand right there, bounce, bounce, bounce. The SPYs have never closed above 610. And if they happen to close above 610, then I would then, and only then, adopt an overall bullish prognosis. And vice versa on the downside. Now, the downside's a little more tricky. There are several lines in the sand that I'll highlight here. 590, look left, support, resistance, support, resistance. I think that level will likely hold. It did here. And so I would say if we crack below the 590 level, that we might be looking for another correction. But it happened here, and then there was an immediate bounce. So very treacherous market. If there's ever a time to snipe, to harness the power of high probability trading, this is it. Because although we're not immune to gaps, we're certainly more immune to gaps than buying stock, shorting stock, buying calls, buying puts. It's more risky now if you're going long anything or short anything. And with credit spreads, we just need to make money above or below a particular line in the sand. Now, let's take a look at our portfolio. We've had a trade close last week on Electronic Arts. We placed this trade on 123 a couple of weeks ago. Let me show you what the trade, actually, this thing expired on the 7th of February, last Friday. Let me show you. And this whole thing expired worthless. So this is the trade at expiration. We weren't able to get out of this trade for 10% of the original credit, which would have been 1 cent. We weren't able to get out because of slippage. Look at that crazy slippage. And so we let it expire, and we netted a full 13.6% on that particular trade. So that added to our win streak. And then Peloton, which is a trade we just placed last week, that trade is already up 8.9%. We're very close to our buyback. So we got 10 cents credit times 100 shares controlled is $10 per spread. We did the spread 5 times and pulled in $50 of credit while risking $450. All right, so I use this software called Tom's Tools, tomsoptiontools.com. tomsoptiontools.com if you're interested in checking it out. It's a really beautiful way to visualize your trades. And I can see here that this is the expiration line. That's max profit there. That's max risk there. And we don't ever get this close unless it gaps all the way down. And we'll get out of the trade for a managed loss right around $100, not 450 if the stock misbehaves, if it closes below the short strike. If you're new today, that's a lot of information, but I've been repeating this stuff on this show for well over a year now, and it's in the guidebook. So if it's a little confusing, just grab the guidebook and come join this free show every Thursdays at 9:15 Eastern Standard Time. All right, this one is due to come off today, next couple of days, I'd say, and certainly unless the stock drops from here, we'll be out of this trade today or tomorrow, most likely. So that one, Ryan, would take us up to 17 if it actually becomes a winner, which it looks like it's going to. In fact, you want to see some probability. This cool software here tells me that we have a 96.4% statistical probability of making money on this trade. And likely we'll make about 10% once we close it down for a penny. If you're in this trade, be sure to have a GTC profit stop to close the order down for 1 cent. 1 cent. All right, we got 2 minutes, Ryan. I want to get right into our trade of the day. Let's pop that graphic up while I get the chart going here. And the candidate is on a company that almost everybody's heard of, Cisco. Cisco came out and blew out their earnings after four successive quarters of less than expected results. The company finally came out and already is up 5% after reporting better than expected guidance and fiscal second quarter results. So what does that mean? That means they made more money than was expected. Their earnings were higher than expected, and they said in the future it's going to get better. So Cisco's revenue grew 9% year over year in the prior quarter, which comes after 4 quarters. I just said that. The company's earnings and revenue forecast for 2025 topped estimates, top forecasts, beat and raise. That's what we like. So here's the stock. And in about 1 minute, the stock will open up right up here at 66. There it is. You can see it. We're using the Hub software here, hub.com. You want to play around with this software. So I'm going to move fast, and I want to get down here at 60. So I want to make money anywhere above 60, and I got to talk fast because this credit may be gone in the next couple of minutes. So what I'm going to do here is put a trade on that will make money anywhere above 60. All right, Cisco's already above 65. It's at 66. So for us to get into trouble on this trade, if we get it filled at 60, the stock's going to have to collapse below 62.50, 63, and then get to 60, where we have our 50-day moving average support level. So that helps us stay safe. I do like Cisco's coming down a bit. Let's see if we can get in at 60. And I've got the order lined up, and there's no credit. Okay, so I'm in. Ryan, I need to slow down, man. I'm excited. All right, so there's 60.59, and I'm asking 10 cents, but I can see it's only worth 4. All right. When you put on a credit spread, make sure that the credit is 10% at least of the spread width. So the spread width here is $1, and therefore I want at least 10 cents credit. Right now, when I put the trade on, selling the 60 puts for Feb 28 and then buying the 59s underneath, I don't see any credit at all. All right, that's a 15-day trade. So there's not enough credit there. So the next step is to move the line closer to the stock to see if we can get 10% of the spread width. So notice that I've just moved the line up here. Why did I pick this line, which corresponds to 61 and let's say 61 and a half, a little bit lower. So it's once you start practicing this, your eyes will automatically see support and resistance. You see how this line here is support here, resistance, resistance, and then became support there. So that line is about 61.50, and I might go a little higher than that, but let's see if we can get something at 61 or 62. And so I'm going to lift this up to 61, only 2 cents credit, and I can go to 62, and I see 17 cents credit. All right, so what that's saying to me is that I'll have to go up to 62 in order to generate enough credit. And Cisco's hanging in. We also have another line in the sand up here at 65. It's a round number. That's a support level, and it could hold. It may not hold, but it is at least a distinct possibility that the stock will remain above 65, and that gives me more comfort coming in here at 62. The other thing is the stock closed here at 62.50 yesterday before the extra good news came out. All right, so the news is better than yesterday. Why would it come back down from whence it came? It might. Sometimes it does, but less likely. So 62 is where I'm going in. Let's see if we can get something there. See, all my yapping, we lost the credit. All right, here's what I'll do then. I'm not going any closer. Let's just see how close. Yeah, 63 would be right about there. That's too close for me. 62 as close as I want to get, right here at 62. Let's go ahead and put the order in for 62. Yeah, but Mike, there's no credit there. Well, ask for it. You can ask for it. They can say no. That's okay. Get used to it. Let the trade come to you. I'll do 5 contracts. And I don't know if this one's good. The only way this one's going to fill is if the stock comes down a little bit during the day. So let me show you what we just did. We sold the Cisco, CSCO is the symbol. Put this in as a GTC if you want to play. And you want to sell the Cisco Feb 28, 62 puts. That 62 corresponds to this line in the sand right here. Let me make it exactly 62. So let me edit, change this to 62 precisely. All right, so that's our line in the sand. That's where we sell our put. We sell the put, we make money above 62, anywhere above 62. And then buy the underlying put, same stock, expiry, and option type, of course, and then get a 10-cent credit on that one. Now, once you're in, the most important part of trading is not making money. The most important part of trading is managing your risk. Manage your risk and let the winners take care of themselves. That's all we've done here for well over a year. These rules, follow the rules, and let probability do what probability do. All right, now, you want to cut your losses. You don't want to take a max loss on these. So if the stock closes less than your line in the sand in this case, if the stock closes less than 62, then you close down the trade for a managed loss. Typically, our losses are 1.5 to 2 times the size of our average gain. So one loss takes out 1 or 2 trades, 1.5, 2 trades, typically. And the system and all the data you've seen supports that that's okay. It works great. And then lastly, let the profits take care of themselves by putting on an order to buy back the spread that you sold for 10% of what you sold it for. In this case, that would be 1 cent. 10% of 10 cents is 1 cent. And you buy it back and you net 9 cents at least. Automatically. You don't have to even touch the winning trades. Your job then only becomes keep an eye on every credit spread you have. And if the stock closes on the wrong side of your line in the sand, shut down the trade. So Ryan, we're going to have to let that one sit a bit, and we may not get filled, but I'm not going to go chasing it. I'm not going to go chasing it. Let's see what the current credit is. Current credit is about 6 cents. So if Cisco comes down a bit more, we might grab this one like a trap, like a crab trap. We have it sitting in the water, and if the stock comes down enough, we'll get enough credit, and we'll be in the trade. And you might even be golfing or something.
I wish.
Hey, dude, I haven't golfed for like two years now. I need to go golfing.
Yeah, same here.
Come on down here. Let's go golfing, man.
Let's go golf, man. All right. Got a couple questions in the chat if you're ready for those.
Yeah, man.
Nice. So we got a couple people have asked about Crocs.
Oh, yeah. You remember those shoes, man?
Oh, yeah. Still have a pair. That's what I wear outside.
Oh, really?
whenever it's like raining or something, I'll wear those outside.
Yeah.
Not in public.
No. It was funny. There was a time when people would wear those things in public with no shame at all, man.
Just
wearing all kinds of colored Crocs. But yeah, the stock, just looking at the stock, it's gapped up. So, and I happen to know that Crocs has just had earnings. So you can go to many places to get earnings news. One simple place to go is finance.yahoo.com. And then you type in the symbol. And then you can kind of see what's up. Earnings went right. That's not enough. Oh, Crocs smashes expectations. Wow. Crocs beats and lift from the Hey Dude brand. Tops estimates sending shares sharply higher. One of the things I'm looking for is future guidance. I would love it if they came out and said, and we did really well this quarter, and we're gonna do better next quarter. I don't see that news. We'd have to dig in. Ideally, you see something like that where they raise their guidance. I don't see it in the headlines, and I'm not going to go digging in, but I'll have you all do that. So then I look at the Crocs stock chart here, and what I don't love about it is Crocs was under a lot of pressure and then has gapped up. And right now, and the first part of this game is this. Start looking for lines in the sand. What are those? Support and resistance levels. Here's a line, and I'll tell you why I'm looking at this level here in a second. But this is 105 exactly. All right, so this morning, the stock, and right now, it's trading, you can look up here, 105.28. So far, this level is holding like it did here, here. Was also resistance, there. Resistance. That's a solid level, but I would say too close to go, but it's a good level to keep an eye on. And on this one, especially given the stock has opened up above 110 and has dropped all the way down to 105. Now it's at 104.40. Looks like it might be filling the gap. So it could. So you got to be careful on this one. This would be one that I would think about maybe trying to get something at 90, but I wouldn't go too much closer. If Crocs starts to recover and then breaks above this level right here, look at that. And guess what? I don't even have to look. I know that's probably going to be close to 115. And that's 114. So pretty close, but 113 is strong resistance. So if Crocs were to breach that level, then I would consider coming in, only then consider coming into maybe 100. But given the stock is at the lows of the day so far, I'd be very careful on this one. I wouldn't go any closer than 90 at all on this one. This might be one to just let marinate for a few hours and then come in later and see if you can get something at 90. And again, I saw this morning, and I was like, the stock's gapped up big. But man, it's below the 200-day average. It's been in a free fall, essentially. Is this earnings news enough to halt this bearishness that I see there. So that was another sort of experience distinction that I have from doing this for 25 years. And so I'd be careful on this one, Ryan.
Be careful indeed. How about TTD?
The trade desk. That was another one I was looking at. The trade desk. Oh, TTD. I'm got the wrong symbol. There we go. The trade desk. They blew out their earnings, man. Like serious. Oh no, I'm thinking of another one. Robinhood. Robinhood. Check out Robinhood. I got them mixed up. They're both in the same business. The trade desk is an online broker, and we can go into TTD and see the news. Hey Ryan, which news do I like better? Really bad news or really good news for trading? For trading,
Really bad news, right?
I like really bad news.
Yeah.
Yeah, like the worst possible news is the kind of news that bad news keeps us. Let me say it in a very distinct, clear way. Bad news has more shelf life than good news. There you go. So if I can find something on the stock like this, the trade desk where the stock has just really tanked, and I can see here the trade desk sinks 29% after revenue misses estimates. All right, and we can dig in here a little bit and get some more granularity. How badly, and I can't see it there. I tell you what, I know another place I can see it. You go to CNBC, I'm gonna give you a place to find candidates. I have a community of investors, traders, snipers that use this a lot. But if you go to CNBC, usually, not always, but almost always, they give you a pre-market mover and then a midday mover. And oftentimes you can get, and they do a really good job of really consolidating the news. And then we can come through here, and I believe I saw the trade desk on here. There we go. So now I got more data, and I don't have to go plunging through multiple news announcements. I can see it in one spot. So let's just take a look at this. Shares plunged 29%. Good. After the digital marketing company reported soft quarterly revenue and issued weak revenue guidance. That's what I was looking for. So think about it. The company came out, was doing pretty well, hanging out here above the 200-day average, and then came out and missed on their earnings per share, and lowered future guidance. And the stock, which was at just over 120 yesterday, is at 84.38 right now. It got taken behind the woodshed and spanked severely. And so now I'm zooming out a little bit. The problem with these is there's so much of a gap, 29% gap down on this, that we've got to come in and start to try to find lines in the sand. Now, ideally, I would love to sell up here at 110. Why is that? Well, that's a round number. It was a support resistance level through here, and we have the 200-day average as protection. So that would be a no-brainer trade, but I doubt you could get much credit. So I'm looking at the stock. I'm thinking, man, maybe that 29% haircut is overdone. Maybe we get some buyers coming in. So I'm just concerned about there being a bounce. Is 29%, a 29% haircut, the right haircut? And maybe it isn't. So I would say no closer than 100 on this one. Or just wait a day and see what it does. But be careful. Be careful on this one. Ryan, we've got time for maybe one or two more.
Yeah, let's look at Hood.
Yeah, that was what I, if you were going to say no stocks, I was going to say, let's look at Hood.
you mentioned it, and I was like, oh man, we got to jump in on that one.
Yeah, buddy, look at this. Robinhood. And the news is right here as well. I almost picked this one this morning, and here's why. The digital trading platform rallied 13% after reporting stronger than expected revenue. Check. And they posted $1.1 1.01 billion in the period, coming in above LSEG estimates of 944.6 million. So they blew it out. I don't see lifted future guidance. I'd like to see that. It's not in this news. You don't have to have it, but it's better if you do. And you can see here that the stock has hit 65. Did you know 65 is a round number? Yeah, you knew that. 65, which is resistance. This is another reason I was a little tentative on this one. But 65 is resistance. All right. And I knew that because it's a round number. And I also knew it because I went back in time and saw that 65 was a resistance level. So far, it's holding. So it's like there's something in the way for the stock to continue rising. There's no blue sky until the stock's above 65. So what does that mean? Well, it means that there's a potential that the stock may retrace. All right, so given that, I want to get further away. If you can get 50, I would say that is close to a no-brainer. Or, zooming in here, I would say 55 is as close as you want to go, but probably not. What about right there? Look at that. Tune your eyes now. This is the most important thing in trading, in my experience, is that you really understand support and resistance. And look here at 53. 53 level was support yesterday, support the day before, support a few days ago, became support on this day, was resistance the prior day, and resistance, and resistance. That is a solid level at 53. So I would take it at 53. I think that's a good level. 50 if you can get it. If not, 53. I wanted to talk about that one, Ryan. Thank you for bringing it up.
Of course. You got time for one more, or are you ready
let's do one more. Yeah. It's snipe. Man, it's like there's so many candidates right now because we're in the heat of earnings season. So let's take a look at one, or at least one more.
How about Sony?
If I can remember the stock symbol. There it is. It's Sony. If I can remember how to spell Sony. Yeah, similar story. The stock has gapped up. Why? I don't know if that was in here or not. Let's see. Just looking through the list. There we go. U.S. listed shares. Sony is it's a foreign listed company. Surged more than 4% following its latest quarterly results. Sony reported net income of $373 billion. That's a lot. Topping the $294 billion. This is yen, by the way. So they blew that out. Huge beat. And revenue for the period, it also came in better than expected. $4 trillion versus $3 trillion. The company also raised guidance. Perfect bifecta, I call it. So there's every reason with them lifting future guidance. That's the best part of the news. Beating is great. Promising more in the future, even better. Less reason for the stock to drop. And then you want to derive your lines in the sand. You could make a case for 23, but that's too close for me. So then I would come down here and consider 22. 22 would be the closest I would get. But if you can get something down here at the bottom of those bars there, look at here, bottom, top, 2150. 2150 would be, in my estimation, a good place to sell a credit spread. Sell a credit spread at 2150 and then follow the rules. All right, Ryan, I think that's a wrap for today. Y'all get that guidebook, please, especially if you're new. And then come join Ryan and I every Thursday mornings at 9:15. Ryan, have a good day. Thanks for being with me, man, and everybody else. And we'll see you next week. Bye, everybody.